All right, so here we go. Let me get my screen shared and off we go. So hello again, I'm Burke Sestock, certified financial planner professional and co-founder of Retirement Wealth Partners. We are based in Harrison, New York, and serve clients nationwide. I also serve the National Financial Planning Association as a member of the board of directors, a 19,000 member organization. Today's presentation is a quick run through of why you might want to be taking some action with IRAs before you file your taxes for 2021. Due to the fast-paced nature of this webinar, I will not be covering every aspect of these IRA tax tips. However, you can reach out to me briefly to chat about your personal situation and ask questions. I'll cover that at the end. With that, let's dive right in. So tip one, if you do not have a retirement plan through work, you still need to be saving for your future. A traditional IRA is available to anyone who shows earned income. You can contribute up to $6,000 each year, and if you're older than 50, you can contribute an extra $1,000 for a total of $7,000. You must have at least that much earned income to max out funding. If this is the first time considering funding an IRA, you can contribute for 2021 until April 15th of 2022. Technically, the date's April 18th because of Patriot Day falling on Friday, but I would not recommend to try to make your contribution on tax day. Get it in at least a business day before. If you file an extension, you can fund 2021 as late as October 15th. If you fund 2021 and 2022 right now, you can get up to $12,000 invested for yourself right away. Contributions to your traditional IRA are tax deductible if you are not also funding another retirement plan, such as a 401k or a 403b. If you are paying an effective 20% tax, making a $6,000 contribution will save you $1,200 for the tax year. So there is real savings in there. Not only do you get a tax deduction this year, growth of investments in your traditional IRA are tax deferred. You will not pay any tax on interest, dividends, or capital gains on investments inside your traditional IRA. You only pay regular income tax in the future when you take money out of the traditional IRA, if you wait until you're at least age 59 and a half. For more details, Google it, but that's the important piece to know. You got to wait till you're at least age 59 and a half to have no tax penalty. So what about my spouse? Many people are not aware of this. If your spouse does not work, you are permitted to make a contribution to an IRA for him or her. I don't really care for the outdated term spousal IRA anymore, but I do love the opportunity to shelter more money from the IRS. The contribution limits and the tax deductions are the same as your own traditional IRA rules. Number two, may feel like a duplicate of the first tip, but both the short and long-term opportunities of funding a Roth IRA are significantly different. You have a choice each year of funding a traditional IRA or a Roth IRA. Technically, you can partially fund each as long as the combination of contributions does not exceed the aggregate limit of $6,000 I mentioned earlier, plus the $1,000 if you're age 50 or older. I rarely see this happen. Generally, you're either going for the largest tax deduction or the largest tax-free account later. Not everyone can fund a Roth IRA, though. People with higher incomes cannot contribute or may have a restriction on contributions. This is the most common situation where you may fund both a traditional IRA and a Roth IRA in the same year. If you are married, filing jointly, starting at modified gross income of $198,000, the amount of money you can contribute to a Roth IRA begins to decline. And if you earn more than $208,000, you cannot contribute at all to a Roth IRA. That same phase-out range for single tax filers is $125,000 to $140,000. Funding a Roth IRA is not a tax-deductible event this year. So why would I want to do it? As long as you follow some basic rules of the plan, namely a 5-year holding period, starting with the tax year you funded the plan, your distributions after age 59 and a half are fully income tax-free. That's awesome. No hard math exists for why you may want to choose a Roth IRA over a traditional IRA, because you would have to know your entire taxable financial future. But In general, if you believe you'll be in a higher tax bracket when you start taking retirement income, you should contribute to a Roth IRA now. If you believe you'll be in the same or lower tax bracket in the future, then the traditional IRA and the current year tax deduction is likely the better choice. Complicating the decision is the question of whether tax brackets will be increased by Congress in the future. Everybody's got opinions on that. We don't know what's going to happen. If you do believe that taxes will be increased, though, a Roth IRA today may be more attractive. The Roth IRA also permits funding for a non-working spouse too, just like the traditional IRA, so you have that opportunity. All right, so those first couple of tips are basic. We're going to kick it up a notch now. If you're a good saver and are currently maxing out your workplace retirement plan, you can still contribute to a traditional IRA up to the maximum limit. The only thing that changes is your contributions will not be tax deductible this year. You might be thinking, why would I want to tie up money to age 59 and a half without a tax deduction? Well, the other rules of the traditional IRA still apply. The most important is the tax deferred growth. This talk doesn't permit time to go into all the potential value of tax deferred growth, but rest assured, as a certified financial planner professional, I can confidently tell you it's worth it. If you plan right, you may get an even better kicker funding your non-deductible traditional IRA as we roll into the fourth tip. If you've often wondered what a tax loophole is, a backdoor Roth IRA is a great example. In 2010, when Congress removed the income thresholds attached to converting traditional IRA assets to Roth, an inadvertent tax loophole was created. A normal traditional IRA conversion to a Roth IRA involves paying the income tax on the amount of the traditional IRA you decide to convert in the year of conversion. Thereafter, you have a Roth IRA with tax deferred growth and tax-free distributions, which is awesome again. However, if you fund a traditional IRA with non-deductible contributions, as we mentioned in the last tip, you've already paid the tax on your traditional IRA. Since anyone can convert traditional IRAs to Roth IRAs in any year because of the 2010 tax law change, and since you owe no tax on the non-deductible IRA contribution, you can immediately convert your non-deductible traditional IRA contribution into a Roth IRA and owe no tax. So despite the income limits on Roth IRA contributions, if you're a high income earner and want to keep funding a Roth IRA, you can still do it. Just make those non-deductible traditional IRA contributions, and following a couple of simple tax rules, convert that immediately to Roth IRA. So let's break this down. You're in a high income, you fully fund your workplace retirement plans. You have more money to save. You are not permitted to fund a Roth IRA, but anyone with the required earned income can fund a non-deductible traditional IRA. So you do that. Boom, next day you convert it, and you have now essentially funded that Roth IRA, skirting the direct Roth IRA contribution limits. So why does this exist? Well, Congress is aware of this loophole and conversations have been held about closing it. However, nothing has been done yet. So take advantage of this every year while you can. I also don't believe this is an item of urgency for Congress because closing the loophole will likely be negative for congresspersons' families on either side of the aisle. That is, Congress people are taking advantage of this as well. So is that a quick tax loophole if they want to close? Probably not. I do need to mention that there are special tax considerations involved when converting money to Roth IRAs. Before you do so, consult your tax advisor. It's not that complicated, but you should be aware. So we just saw how traditional IRA conversions to Roth can be beneficial in a current year with the backdoor Roth IRA. This works well when you have high income. But what if you have traditional IRA assets and you have low or no income in a particular year? Certainly, 2020 and 2021 are years when this may have happened with layoffs and other changes due to the pandemic. A lot of people made less money those years. Another opportunity exists for long-term planning, especially if you retire before you turn age 72. So we're going to look at both of those. As I mentioned earlier, Roth IRA conversions make sense when you're likely to pay lower income tax this year than when you plan to take the distributions from your IRA in the future. This is something you should think about every year when you prepare your tax filing. While it's impossible to say how much income tax you'll save over a lifetime, Making smart IRA conversion decisions are very meaningful when done with foresight. So let's take a look what happens if you had a low or no income year in 2021. Opportunities for traditional IRA conversions to Roth exist in every year. The pandemic has created a lot of those opportunities due to unemployment or underemployment. If you earned less or nothing in 2021, you likely can take advantage of a conversion. In fact, if you earn no income in 2021, you may be able to convert some traditional IRA money to Roth IRA completely tax-free. How is that possible, you ask? Well, every taxpayer receives a personal exemption and can take advantage of the standard deduction. Earned income amounts up to those combined amounts are not taxable to you. Just examining the standard deduction for single filers in 2021 of $12,550, if you earn nothing, you should confirm with your tax professional and convert at minimum that amount from your traditional IRA because it won't be taxable to you, right? So for whatever reason, if you made less or no money last year, take advantage of it, make some smart tax decisions that won't even cost you anything. The numbers are different with different personal exemptions, child tax credits and marital status. Just be aware that you still have income tax thinking to do, even if you have no earned income to file. So basically don't skip tax season if that's an opportunity for you. Free is cooler, yet there are opportunities for people who earn less during the pandemic and still owe income tax. Two easy windows to identify occur when the federal tax brackets have big percentage increases. These aren't the only ones, but these to me are the most obvious. Large tax jumps exist between the 12 and 22% tax brackets and the 24 and 32% tax brackets. If your 2001 lower income drops from higher to the lower of these bracket gaps, you may have an opportunity to make a tax advantage conversion. I like to call this filling up the tax bracket. That is, if you know your income is going to jump back up in future years, but temporarily 2021 finds you falling back into the 12 or the 24% tax bracket that you wouldn't otherwise be in, then fill up the tax bracket with traditional IRA to Roth IRA conversions at the lower tax rate. Factually, as I said earlier, this opportunity exists at every tax bracket jump. So consult a certified financial planner and a tax preparer to identify opportunities in any year where your income dips down. We're focusing on 2021 and 2022 in this presentation, but this is true of every year. All right, so what happens if you're older and you're retired? The other common time income dips down is when clients retire and have a well-developed plan for income. The best opportunities exist in years before your IRS required minimum distributions begin at age 72. You can Google that too if you need more information on it. This is also a good example of planning early for retirement and why it's so valuable. If you retire before age 72 and have regular tax savings to draw from to help fund your living expenses, your taxable income is likely to be much less than it was while working, right? So let me just clean that up a little bit. Let's say you made $250,000 before retirement, but your living expenses are $100,000 and you saved into regular accounts that you just have to pull money from and you've already paid the income tax on it. If you draw from those accounts, you don't have to draw from your retirement plans, and your income taxes should be significantly less. So during those years, traditional IRA conversions to a Roth IRA can help you clear income tax at a lower tax bracket, right? So the whole IRS game is all about figuring out how you can pay less tax when they want you to pay more. Done intelligently before age 72, there's a big window. So when RMDs kick in for you at age 72, high retirement plan balances mean higher required minimum distributions. This is essentially forced taxable income, right? You got that tax deferred growth, but eventually the IRS says, hey, we want our money. And that's age 72, they start making you take it and pay the income tax on it. At age 72, the percentage you must distribute from your combined pre-tax retirement plan balances is 3.9% of the total balance of your IRAs and retirement plans. And that number increases every year. So if you have $1 million retirement plan balance at age 72, This means an additional $39,000 of forced income, whether you need the income for living expenses or not. If you are married and you add in 2 Social Security incomes and any pensions plus RMDs, you can easily be pushed into a higher tax bracket. What if you retire at 66 and spend the next 6 years converting $50,000 of traditional IRA each year in preparation for those required minimum distributions? You will have cleared tax on $300,000 of that $1 million plan balance and reduced your retirement plan totals that will be used to calculate your RMD. So you paid the tax, you now have $300,000 in Roths. Your IRA balances are now $700,000 instead of $1 million. That $700,000 at 3.9% is going to give you less taxable income than if you had the full $1 million plan balance. So you're going to save some taxes there. As you can see, you may be able to save tax with plan conversions, and that has a ripple effect during RMD years. So moving on, getting close to the end here, with the change in tax laws under the Secure Act, beneficiaries of IRAs have lost the value of stretching inherited IRA assets. They must now fully distribute inherited IRA plan balances by the 10th year after the bequeathel's death. It's very possible that when you pass away, your likely heirs, your children, will be in their highest earning working years. So think about that, right? So if you live into your mid 80s and your children are roughly 25 years younger than you, they're going to be in their early 60s, right? That's probably the time you're making the most money, and it'll be the same for them. So this means when they inherit an IRA and have to distribute in those next 10 years, right? Let's just say age 60 to 70, that income is going to be stacking on top of whatever they're earning through their most powerful earning years. This means they could be paying an inflated income tax due to retirement plan inheritance and distributions in that 10-year window, and can even bump you up, another tax bracket. So not only are you paying more tax on more income, you could be paying it at a higher rate. By considering all the conversion ideas I presented today, you can have a lifetime strategy of moving traditional IRA assets to Roth IRAs in a more tax optimal way. When that time comes, Roth IRA remains tax-free assets when they are inherited too. So if you've converted from traditional IRA to Roth IRA, and while you're living, you don't burn through the entire Roth IRA balance, when you leave it to your heirs, probably your kids, they're not going to owe any income tax on it either. So you get around that income tax spike while they're in their highest earning years. So that 10-year window could be filled with non-taxable Roth IRA distributions that do not jack up your children's income tax. So in summary, fund your traditional IRA, fund your Roth IRA, make non-deductible IRA contributions, execute on the backdoor Roth IRA if applicable, and know when and how to execute traditional IRA conversions to Roth IRAs. If you do those things well, you're going to see your net worth be significantly better in the future because you've managed around a tax situation that you can actually take advantage of. While none of us want to pay tax, the game, again, is to pay the least, and planning ahead makes a difference. So if you have questions, we're going to field some of those in just a moment. But if you want to reach out to us, you can schedule a Zoom meeting with us. We try to make it as easy as possible for you to learn more. If you want, you can book right into my calendar using my OneHub link that you'll see on the screen. Emails are responded to in 24 hours and same day when possible. You can also call me directly, although my busy schedule does not result in my picking up all the time. You'll get my voicemail, but I will call you back. Feel free to text the same number, so that 914-220-6196. You can text. The first message you send, you'll get an auto reply asking you to accept text messaging, and then we're free to chat away. And please visit brightirement.com if you wish to learn more about us. To close, please let me emphasize that we do not solicit you if you reach out with questions regarding this presentation or other financial topics. We believe in helping people, and if 15 minutes of my time can make your financial life better, I'm happy to help. If you do want more information regarding working with Retirement, my team, you can ask about our professional services and we will provide that information to you, but only if you ask. In brief interactions, if the situation is complex and would require a business agreement, I will let you know in advance and you're free to reach your own decision on that. Thanks for your time and have a prosperous 2022.